You are standing on the floor of the New York Stock Exchange. It is October 24th, 1929. The opening bell rings. In the first few minutes, the market crashes 11%. This is Black Thursday. You tell yourself it's a correction. You hold. Then comes Black Monday. The market crashes another 12%. Panic peaks on Black Tuesday. This wasn't a bad week. It was the beginning of a deflationary spiral that wouldn't bottom out until 1932. Fast forward to 2008. Lehman Brothers collapses. Fast forward to 2020. A pandemic halts the global engine. Different triggers, same mechanics. But in every single one of these scenarios, while millions lost their savings, their homes, and their futures, a specific set of 5 assets didn't just survive. They thrived. History has left us a forensic trail of breadcrumbs, and most of you are ignoring it because you're distracted by the noise. We are going to look at the cold, hard data from 1929, 2008, and the 2020 recession to isolate the 5 assets that survive when the system breaks. Before we name the assets, you need to understand the mechanism of the collapse. A crash is never a singular event. It is a cascade. In 1929, the crash triggered a deflationary depression. In 2008, the housing bust triggered a liquidity crisis. In 2020, a biological shock triggered a supply chain collapse. History proves that the safe asset changes based on the type of crisis. But the psychology remains identical. In the Roaring '20s, investors leveraged 10-to-1 on stocks. They thought they were different. They thought the paradigm had shifted permanently. Then, the market decimated them. In 2006, U.S. housing prices peaked, and homeowners leveraged to the hilt believing property values were invincible. By 2009, the average U.S. house had lost 1/3 of its value. They thought they were different. We are seeing the same signals today. Volatility in digital assets dwarfs historical collapses. Look at the headlines. Cardano founder Charles Hoskinson lost $2.5 billion in 4 years. That is wealth compression happening at warp speed compared to the slow bleed of the 1930s. To survive what is coming, we have to look at what worked when the world stopped working. Asset number 1, gold. But not for the reason you think. This isn't about getting rich. It's about not becoming poor. Let's look at the forensics of 2008. The banking system was insolvent. Liquidity evaporated. The logic of the panic says, cash is king, right? Wrong. While the S&P 500 was bleeding out, look at gold's performance. In 2007, as the cracks formed, gold returned plus 31.6%. In 2008, the year the world ended, gold defied the sell-off and returned plus 5.4%. Then, as the printers turned on in 2009 and 2010, gold posted gains of 25.0% and 25.9%. Go back further. During the Great Depression, specifically 1929 to 1935, the price of an ounce of gold rose from just under $21 to $35. That is a 67% increase in purchasing power, while the cost of everything else was collapsing. It demonstrates immunity to the system because it is outside the system. Irony is your best indicator here. In 2008, central banks flooded the market with liquidity to save the banks, which devalued the currency, which is the exact mechanism that drove gold prices up. They printed money to fix the problem, and in doing so, rewarded the people holding the anti-money. Asset number 2, productive land. Note the word productive. There is an old saying by an industry expert, buy land, they aren't making it anymore. This relies on strict supply constraints to survive currency debasement. However, we have to be forensic analysts here, not cheerleaders. Land is safe, but commodities can be lethal. During the deflationary spiral of 1929 to 1933, agricultural commodity values were decimated. They shrank from $5.2 billion to $1.7 billion in just 4 years. Hardest hit were farm commodities. So why is land on this list? Because while the income asterisk from the land dropped, the asset itself survived the total wipeout of paper wealth. If you owned the land, you survived the 1930s. If you owned the paper debt on the land, you were erased. The lesson from the FDIC's historical data is clear. Banks fail. In the 1980s crisis, thousands of banks failed. In 1929, 9,000 banks failed. The land remained. It is the ultimate hedge against counterparty risk, but you must own it outright. Leverage on land kills you. The land itself saves you. Asset number 3 is controversial, but the data demands we include it. The too big to fail banking stocks. According to a 2020 FDIC report titled Survival of the Biggest, Interventions explicitly intended to prevent failure are very common for top 5 banks, but a lot less common for banks 6 to 20. This is the ugly truth of the system. In 2008, if you held regional bank stocks, you went to zero. If you held the giants, you were diluted, but you survived because the government effectively nationalized the losses. The 1929 data shows a similar concentration. The recovery pattern favors the titans. Asset number 4, essential energy and defense. During the 2020 pandemic, oil briefly went negative. But look at the rebound. Energy is the biological requirement of the economy. You can stop buying iPhones, but you cannot stop heating your home. And finally, asset number 5, the US dollar. Yes, the very thing being debased. In a global liquidity crisis like 2008 or the European sovereign debt crisis of 2010 to 2012, capital flees to the deepest market. The dollar spikes before it dies. It is the cleanest dirty shirt theory. In the initial shock of a crash, the dollar strengthens as debt is repaid. It is a short-term survival asset, not a long-term wealth builder. The pattern is undeniable. 1929, 2008, 2020. The triggers change, but the assets that survive remain constant. Gold, productive land, systemic institutions, energy, and cash liquidity for the initial shock. The crowd in 1929 didn't see the 89% drop coming. The crowd in 2008 didn't see the foreclosure signs coming. Today, you have the data. You have the history. You think you are different? Prove it by being prepared. Class dismissed.